What if I told you that the secret to consistent profits in trading isn't about chasing indicators, following the news, or timing the market perfectly? It's about understanding one simple truth. Price moves because of supply and demand. That's it. In every market, every time frame, and every asset, this fundamental law is what drives the action. Yet most traders overlook it. Welcome to Book Loom, the channel where we unravel powerful trading books and deliver real insights to help you level up your game. In today's video, we're revealing The Real Edge, Supply and Demand Trading by Frank Miller. This isn't another theory-filled book. It's a practical, no-nonsense guide that shows you exactly how to spot where the big players are entering and exiting the market, so you can ride the wave before the crowd even sees it coming. If you're tired of overcomplicated strategies and want a method rooted in raw price action, this might just be the breakthrough you've been waiting for. Chapter 1. The Core Principle, Supply and Demand. Let's start with the golden rule of trading. And no, it's not buy low, sell high. That's the outcome. The rule is this: price only moves when there's an imbalance between supply and demand. Frank Miller begins the book by cutting through all the noise, moving averages, RSI, news, Fibonacci, candlestick patterns, and brings our attention to the one force that actually drives the markets: supply and demand. Think about it. If there are more buyers than sellers at a given price, demand is greater than supply. What happens? Price goes up. Flip it. More sellers than buyers. Supply overwhelms demand. Price drops. This isn't theory, it's economics 101. But what makes it powerful in trading is how this imbalance reveals itself on the chart, and how professionals use it to predict future price movement. Why most traders miss it. Most retail traders chase signals. They react to lagging indicators and flashy patterns. But by the time a moving average crosses or a candlestick forms, the move has already started, and you're late. Frank Miller teaches that pro traders don't follow signals, they follow footprints. These footprints are left behind in price action where strong buying or selling happened. This is where supply and demand zones come into play. What are supply and demand zones? A demand zone is an area where big buyers entered the market with force, usually seen as a sharp move up from a consolidation base. A supply zone is where strong selling pressure pushed price down rapidly from a base area. These zones aren't guesses. They're visual evidence of where big money, institutions, banks, funds, got involved. And here's the kicker. They often come back to those areas to add to their positions. That's your edge. Why price always returns to zones. Frank explains that institutions can't enter massive trades all at once without moving the market too much. So they build positions in chunks, and those chunks create repeatable patterns. When you learn to recognize these zones, you're no longer reacting, you're anticipating. You're entering at high probability locations before the move starts. You're aligned with the smart money, not trapped with the crowd. This is the core of Miller's strategy. Stop guessing, stop chasing, and start reading the chart for what it really is, a story of buyers and sellers. This chapter lays the foundation for everything that follows. It's not about being right on every trade. It's about understanding what causes price to move and being on the right side of that movement more often than not. But here's the real challenge. How do you identify these zones on a chart with confidence, without getting faked out by weak or already used levels? We will know in the next chapter. Chapter 2. Identifying Key Zones. So now that we understand the real driver of the markets, supply and demand imbalances, the natural next question is, how do we actually find these powerful zones on a price chart? That's exactly what this chapter is about, spotting the exact areas where institutions are buying and selling, so you can enter the market with confidence, not guesswork. And here's the good news. Frank Miller's approach doesn't require any indicators or advanced tools. All you need is a clean candlestick chart and a trained eye. What makes a zone? A supply zone is a price area where strong selling caused a sharp drop. A demand zone is a price area where aggressive buying led to a strong rally. But it's not just about seeing where price moved quickly, it's about identifying the origin of that move. That's where the institutions took action. That's where you want to set your trap. Step by step, how to identify a strong zone 1. Look for sharp moves away from a base. Find areas on the chart where price consolidated briefly, then suddenly exploded upward or downward. This shows strong imbalance, meaning big players entered. 2. Mark the base. The base is where the order was likely placed. This will be your zone, usually marked from the open to the close of the candles, just before the strong move. 3. Zone must be fresh. A fresh zone means it hasn't been touched again since the move. The more untouched it is, the more likely it still holds unfilled institutional orders. 4. Look for clarity, not clutter. Clean moves are key. Avoid zones with lots of back-and-forth candles or overlapping wicks. Clear, sharp, directional movement is what you're after. Key patterns, DBR and RBD. Frank introduces 2 simple yet powerful formations. Drop base rally, DBR. Price drops, forms a base, where demand is building, then rallies up. This creates a demand zone at the base. Rally base drop, RBD. Price rises, pauses, base, then crashes. This forms a supply zone at the base. These patterns are visual markers of where market makers step in, and they appear across all time frames, from 5-minute charts to monthly. Strength of a zone. Not all zones are created equal. Frank shares a few signs that help you judge the strength of a zone. The speed of the move, faster, more imbalance. The distance traveled, bigger rally/drop equals stronger orders. The number of candles in the base, fewer candles, more explosive zone. Freshness. Untouched zones are the most reliable. If a zone has already been tested once or twice, the institutional orders may already be filled. Frank calls these used zones, and he warns against trading them blindly. Common mistakes to avoid. Trading zones after multiple tests, they've lost their edge. Marking zones during news spikes, those aren't true institutional footprints. Forcing zones in choppy markets, wait for clarity. Frank's golden rule, only trade clean, obvious, and fresh zones. If it's not clear, it's not worth it. Real chart insight. Frank includes several examples showing how a simple price drop, followed by a base and an explosive rally, predicts future support. Time and time again, when price returns to that zone, it reacts. Why? Because the smart money is still there, waiting to complete their orders. And that's your edge as a trader, identifying where the professionals will likely return. Once you've marked your zones, how do you know when to actually enter a trade? And more importantly, where do you place your stop loss so you're protected without getting prematurely knocked out? We will know in the next chapter. Chapter 3. The Psychology Behind the Zones. So far, we've learned how to spot supply and demand zones on a chart, but here's something most traders completely miss. What's actually happening behind those zones? What do those price movements really represent? In this chapter, Frank Miller takes us inside the mind of the market, revealing the psychological forces at play when price reacts to supply and demand zones. And once you understand this, you'll stop seeing candles and start seeing human behavior, fear, greed, hesitation, and pressure, playing out in real time. Why psychology matters. Markets are driven by people, or more specifically, by how people perceive value and opportunity. When traders see price dropping fast, fear kicks in. When they see it rising sharply, greed takes over. When price returns to a previous zone, uncertainty creeps in, and only those with clarity and confidence win. Frank emphasizes, every zone is a snapshot of human emotion under pressure. It's where traders got trapped, panicked, or executed with conviction, and those emotions leave behind patterns you can use to your advantage. The psychology of demand zones. Imagine this. Price drops to a level, then suddenly rockets upward from a small base. That's not retail traders buying randomly. That's smart money stepping in with heavy orders. Why? Because to buy big, they need sellers. So they let price fall, inducing panic, until enough sellers flood the market. Then they scoop up massive positions and push the price up. Now, when price comes back to that zone, here's what happens psychologically. Retail traders remember the bounce and try to jump in. Institutional traders may reload, filling more orders. Sellers who regret selling too soon start buying back. The result? A new rally. History repeats itself. The psychology of supply zones. Same concept, flipped. Price rises fast, then crashes down from a small base. That base is where institutional sellers entered. Retail traders often mistake the drop as temporary and try to buy the dip. But they're walking into a trap. When price returns to that supply zone, trapped buyers exit, creating more selling pressure. Institutions sell again, protecting their positions. New traders short the level, following the pattern. The result? Another drop. Zone validated. Trap setups and emotional pain points. Frank warns about trap zones, where the market reverses just before or just after a major level to trigger stop losses. Why? Because institutional traders know where retail stops are hiding. They trigger them to create liquidity, fuel for their trades. These areas become emotional pain points. Traders feel regret for entering too early. Others feel fear after being stopped out. Some chase the move and enter too late. This emotional volatility leads to predictable reactions, which you can trade if you stay calm and follow the zone logic. Mastering the mental edge. Frank's big message in this chapter is this. If you only look at zones technically and ignore psychology, you'll always be one step behind. But when you understand why price reacts at certain levels and how traders respond emotionally, you become a calm, confident decision maker in a sea of chaos. Quick recap. Zones reflect emotional decisions of traders under pressure. Demand zones. Fear-based selling followed by strong buying. Supply zones. Greed-based buying followed by heavy selling. Knowing the psychology behind the move gives you a mental edge. You understand what others feel and trade what they miss. Once you've spotted a zone and understand the psychology behind it, how do you actually time your entry with precision? What if the zone fails? What if price overshoots it? We will know in the next chapter. Chapter 4. Entry, Stop Loss, and Profit Target Strategies. You've found a strong zone. You understand the psychology behind it. But here's the real question that separates amateurs from professionals. When do you pull the trigger? Where do you place your stop, and how do you lock in profit without second-guessing yourself? In Chapter 4, Frank Miller answers this with surgical precision. Because in trading, your entries and exits aren't just technical, they're your survival. Step 1. The ideal entry strategy. Frank introduces a simple, repeatable method for entering trades at high-probability zones. Checkmark, set and forget entry, aggressive. Place a limit order at the edge of the zone, no confirmation needed. Ideal for traders who trust the setup and want the best price. Pro, you catch the full move. Con, no confirmation, it could break the zone. Confirmation entry, conservative. Wait for price to enter the zone, then watch for signs of rejection. Pin bars, engulfing candles, strong reversal candles. Enter once the reversal candle closes. Pro, higher accuracy. Con, slightly worse entry price. Frank says, let the market prove the zone is valid before you risk your money, especially in volatile conditions. Step 2. Where to place your stop loss. This is where most traders go wrong. They either place stops too tight and get shaken out, or too wide and risk too much. Frank's rule: always place your stop just beyond the zone's edge, outside the noise. For demand zones, below the base of the zone. For supply zones, above the base of the zone. Bonus tip: if you enter with confirmation, your stop can be tighter, just below the confirmation candle. He warns, never place your stop inside the zone. That's like standing in the fire and hoping not to get burned. Step 3. Setting realistic profit targets. Profit targets are not dreams. They're strategic decisions based on market structure. Frank gives 3 key methods. 1. Opposing zone method. Exit at the next opposing zone. Example: if you buy at demand, sell at the next supply. 2. Risk to reward ratio. Aim for a minimum 2-to-1 or 3-to-1 reward to risk. This ensures long-term profitability, even with a 50% win rate. 3. Scaling out. Take partial profits at 1-to-1 or 2-to-1, then let the rest run. Helps manage emotion and lock in gains while staying in the trade. Frank's advice: be systematic. Your exit should be as deliberate as your entry. The power of the complete plan. When all 3 elements, entry, stop loss, and target, are clearly defined, you take emotion out of the game. No chasing, no panicking, just execution. Frank reminds us, a trader with a plan can lose and still come back stronger. A trader without one will always be one step from disaster. Quick recap. Use limit entries for best price or confirmation entries for safety. Place stops just outside the zone, never inside. Target opposing zones or use fixed R to R ratios for consistency. Stick to your plan. Don't let your emotions rewrite your strategy. Now that you know how to enter and exit trades like a pro, a bigger challenge awaits. How do you manage trades in real time? What if price hesitates or reverses midway? Do you hold, close, or adjust your plan? We will know in the next chapter. Chapter 5. Multi-time frame analysis. Have you ever entered a perfect trade setup, only to watch it crash against you moments later? You spotted the zone, you placed the entry, and still, boom, it failed. Frank Miller reveals the most overlooked reason for this. You were trading against a bigger force on a higher time frame. This is where multi-time frame analysis, MTFA, becomes your edge. In this chapter, Frank teaches how to align your trades with the dominant trend by analyzing zones across multiple time frames. Think of it as zooming out to see the full battlefield before launching your attack. Why multi-time frame analysis is non-negotiable. Most losing trades don't fail because the trader was wrong about the zone, but because the zone was too small to matter in the bigger picture. Frank compares it to swimming against a current. No matter how strong your stroke, you'll get pulled back if the larger wave is against you. How to apply multi-time frame analysis, step by step. Frank breaks MTFA into 3 levels. Step 1. Identify the higher time frame, HTF, structure. Use the daily or 4H chart to identify major supply and demand zones. These zones control the broader market moves. Ask, is price currently near a major HTF zone? If yes, expect powerful reactions. Step 2. Drop to the trading time frame, TTF. Use the 1-hour or 15-minute chart to plan your trade. Only look for entries that align with the HTF bias. Example: if HTF is near a demand zone, look for longs on the TTF, never shorts. Step 3. Use the entry time frame, ETF, for precision. Go to 5M or 1M charts to time your entry. Look for confirmation candles inside the TTF zone that aligns with the HTF zone. This gives maximum precision with minimum risk. Frank's golden rule: your trade should look like a sniper shot on the 1M chart, but have the backing of a tank from the 4H chart. Example of aligned trade 1. 4H chart shows price approaching a strong demand zone. 2. On the 1H chart, Price enters the zone and forms a base. 3. On the 5M chart, a bullish engulfing candle appears. 4. You enter, place stop just below the zone, and target the next HTF supply zone. Result? You're not just reacting, you're strategically positioned with the market flow. Why this works so well? Higher time frames show the true market direction. Lower time frames give you entry precision and better risk-reward. This method filters out bad trades and confirms high-quality ones. Frank says, one good trade in alignment with multiple time frames can outperform 10 random setups. Quick recap. Always start with the higher time frame. Find the trend and key zones. Drop to your trading time frame to find clean setups. Use a lower time frame for sniper entries and tighter stops. Align all three for maximum clarity, confidence, and control. Now that you know how to align your trades across time frames, the next challenge is handling different market conditions. Because here's the big question. What happens when the market shifts? When trends break, volatility spikes, or the zones stop working like they used to? We will know in the next chapter. Chapter 6. Trade management and scaling. Let's face it, most traders focus only on entries, but real profit? That's made in the management. In this chapter, Frank Miller pulls back the curtain on what happens after you're in a trade. How professionals ride their winners, cut their losers, and scale positions without losing their minds. Because the entry only opens the door. It's how you manage the trade that decides whether you walk into profit or pain. Trade management, the art of staying in control. Frank teaches that great trade management is about removing emotion and replacing it with predefined actions. 1. Letting the trade breathe. Don't panic the moment price dips after your entry. Noise is normal, even in winning trades. Give your zone space to work. Pro tip. Avoid staring at the 1-minute chart after entering. That's a fast lane to self-sabotage. 2. Active versus passive management. Passive management means you set your stop and target and walk away. Active management means monitoring price action and reacting with rules. O, moving stop to break even at 1-to-1. O, trailing stop behind structure. O, taking partial profits as targets are hit. Frank prefers a hybrid approach. You let the trade develop naturally, but manage risk actively only when necessary. The power of scaling. Now, let's talk about scaling, not just entering with one big position, but adding or reducing size as the market confirms or evolves. 1. Scaling in, adding to a winner. Add to your position only when O, price moves in your favor, O, a fresh supply-demand zone forms in the same direction. Helps you maximize your edge when the market is on your side. Frank's warning, don't scale into losing trades. That's not trade management. That's hope. 2. Scaling out, reducing exposure. Lock in profit by taking partial exits at key levels. O, first exit at 1-to-1, or structure break, O, second exit at opposing zone, O, leave a runner to ride the full move. This relieves psychological pressure and lets your winners breathe. Locking in profits. Without regret. One of the most valuable strategies Frank shares is the trailing stop, a method to let profits grow while protecting your gains. Popular trailing methods. Trail below swing lows for buys. Use moving averages, like the 20 EMA. Trail manually as new zones form. This ensures you never give back too much and lets you ride strong trends longer. Frank says, you don't need to be right all the time. You just need to let your winners be big and your losers be small. Quick recap. Manage trades with logic, not emotion. Use a blend of active and passive management. Scale in only when there's confirmation. Scale out to lock profits and ease stress. Use trailing stops to stay in the move while guarding your gains. You've now learned how to enter, manage, and scale trades like a pro. But here's the real test of your strategy. How do you know it actually works over time? What's the secret to building confidence, consistency, and adapting your system to changing markets? We'll find out in the next chapter. Chapter 7. Real Chart Examples. It's one thing to learn about supply and demand zones, but it's something else entirely to see them work in real market conditions. In this chapter, Frank Miller brings theory to life by walking us through real chart examples that show how everything you've learned, zones, entries, stop loss, profit targets, scaling, and multi-time frame analysis, actually works in practice. This is the moment where trading starts to click. Because now, it's not just strategy, it's execution with confidence. Example 1. Demand zone breakout on the EUR-USD 1-hour chart. Frank highlights a strong drop-base rally pattern where price drops aggressively, forms a base with tight consolidation, then rallies upward, breaking previous structure. Key lessons from the chart: the zone is clean, no overlap with messy price action, entry came on the retest of the base, stop was placed just below the wick. 3-to-1 reward-to-risk ratio hit perfectly at next supply. This example proves the importance of clear zone structure and patience for the retest. Example 2. Supply zone rejection on NASDAQ, 4H chart. A classic rally-based drop zone forms after an extended uptrend. Here's what happens. Price rallies and stalls at the top, builds a base, then drops sharply, creating the supply zone. On the retest, price touches the zone to the pip and collapses, Frank explains. You don't always need confirmation if the zone is clean and comes after imbalance. Trade takeaway. Use these fresh, untouched zones for aggressive entries. Stop above the zone, tight risk. Profit target at next demand. Fast reaction, minimal drawdown. Example 3. Multi-time frame alignment on gold. Daily plus 1 hour plus 5 minutes. This one ties it all together. Daily chart, price approaching a strong demand zone. 1-hour chart, formation of higher lows within that zone. 5-minute chart, bullish engulfing candle confirms the bounce entry is taken on 5M with stop below the wick, target set near daily resistance. Result: high probability, low risk trade with a 5-to-1 reward to risk setup. Frank emphasizes, this is how you stack probability. Higher time frame context, clean structure, and precision entry. Bonus example, scaling in on crude oil. 1H. Price enters a demand zone, reacts, and pulls back. Frank adds the first position on the initial bounce, adds the second position after a higher low forms, trails stop under structure with partial exits along the way. This example highlights how professionals build a position over time rather than all at once. Why these examples matter. It's easy to get overwhelmed by candles, indicators, and signals. But these charts bring clarity. You'll notice, zones are not random rectangles. They follow rules. Entries are based on structure and confirmation, not emotion. Stops and targets are logical and pre-planned. Every trade tells a story of imbalance and reaction. Frank's goal here is clear. If you can spot these patterns in the past, you can learn to trade them in the present. Quick recap. Study real charts to train your eye for high-quality zones. Use multi-time frame analysis to stack probability. Follow the rules. Wait for clean structure, retests, and confirmation. Trade management and scaling should respond to the market, not control it. By now, you've seen how powerful the supply and demand method can be when executed properly. But let's ask a bigger question. What does it really take to go from knowing this strategy to becoming consistently profitable with it, day in and day out? We'll find out in the next chapter. Chapter 8. Developing a winning mindset. You can master supply zones. You can time perfect entries. You can even have the best strategy in the world. But without the right mindset, none of it will matter. This chapter is the soul of the book. Frank Miller dives deep into the mental game of trading, where winners are built and emotions are conquered. Because trading isn't just about price charts, it's about what happens between your ears. Why mindset matters more than method. Most losing traders don't fail because of poor strategies. They fail because they panic when a trade goes against them, overtrade after a loss, get greedy after a win, abandon their plan mid-trade. Frank writes, "The market is a mirror. It reflects your discipline or your lack of it. To win, you need to detach from money and focus on executing your process." Common mental traps that kill traders. 1. Fear of losing you. Hesitate to enter trades or move stops too soon. This stems from not trusting your edge. 2. Overconfidence. After a few wins, you increase size recklessly. That's ego trading, not strategy. 3. Revenge trading. You lose a trade, then jump into the next setup without confirmation. It's emotional gambling. 4. Impatience. Waiting for a perfect zone or retest feels boring, so you enter too early. The fix? Frank urges traders to journal these reactions and label the emotion behind them. That's how you build emotional intelligence in real time. The traits of winning traders. What separates the amateurs from the pros isn't talent, it's temperament. Frank highlights 5 core traits every profitable trader must build. 1. Patience. Wait for your zone. Wait for confirmation. Wait for your edge. 2. Discipline. Follow your rules even when emotions scream otherwise. 3. Confidence. Trust your process, not the outcome of one trade. 4. Resilience. Bounce back from losing streaks with a clear head. 5. Adaptability. Review, evolve, and refine your system based on data, not feelings. He writes, "A trade is not a test of your worth. It's a probability play. Take the setup. Move on." Practical mindset tools. To develop these traits, Frank recommends journaling every trade, noting both technical details and emotional reactions, visualization before each session, see yourself acting with calm and precision, pre-trade checklists to remove emotion from decision-making, weekly reviews to celebrate rule following, not just wins. Bonus tip: set process goals, like follow my rules for 5 trades in a row, instead of outcome goals. Make $500 this week. A personal note from Frank. Toward the end of the chapter, Frank shares something heartfelt. "The moment I stopped chasing money and started chasing mastery, that's when I became profitable." It's not about being perfect, it's about being consistent. If you can show up day after day, follow your plan, and manage your emotions, you will separate yourself from 90% of traders. Quick recap. Master your mindset to master the markets. Avoid common emotional traps like fear, revenge, and overconfidence. Build traits like patience, discipline, and confidence. Use journaling, visualization, and reviews to stay grounded. Focus on the process, not the outcome of one trade. Now that you've learned the mindset of a successful trader, let's bring it all together. What does a complete, personalized trading system look like? One that reflects your psychology, your risk appetite, and your lifestyle? We will know in the next chapter. Chapter 9. Building your supply and demand trading plan. You've come a long way. You now understand supply and demand zones. You've studied entries, exits, multi-time frame analysis, trade management, mindset, and real charts. But now comes the moment of truth. Can you turn all of this into a personal trading system that's consistent, repeatable, and tailored to you? In this final chapter, Frank Miller guides you step by step through creating your own trading plan, a plan that acts like your GPS in the markets, keeping you on track no matter what, because knowledge without structure leads to confusion. But knowledge with structure? That's where transformation happens. Step 1. Define your trading style. Frank begins by asking you to get honest with yourself. Do you prefer day trading, swing trading, or position trading? How many hours a day can you realistically dedicate to trading? Are you comfortable with fast decisions, or do you prefer slower setups? Your trading plan must fit your lifestyle and personality, not the other way around. Step 2. Identify your setup criteria. Next, define the exact rules for your setups. What qualifies as a valid supply or demand zone? Do you need a drop-based rally or rally-based drop structure? What kind of confirmation do you need before entry? What time frames will you use for structure versus entry? Frank suggests picking one core setup to master before expanding. Simplicity wins. Step 3. Plan your entries, stops, and targets. Now, write down your entry method. Limit order on retest, breakout, or with confirmation candle. Where you'll place your stop loss, beyond the zone or under structure. How you'll set profit targets. Fixed RR, next opposing zone, or trailing stop. Everything should be defined before the trade, not during. Step 4. Risk management rules. Without risk control, even the best setup can destroy your account. Frank recommends risking 1% or less per trade, defining your maximum daily weekly drawdown limits, avoiding overexposure to correlated markets, using a risk-reward ratio of at least 2-to-1 rule of thumb. Trade to stay in the game, not to get rich overnight. Step 5. Create a trade journal. A winning trader is a reflective trader. Track each trade's date and time, setup type, entry, stop, and target, result. Most importantly, your emotional state. This journal becomes your mirror and your mentor. Step 6. Weekly review routine. Every weekend, review. Winning and losing trades. Whether you followed your plan, emotional patterns, areas for improvement. This is where real growth happens, not during trading, but after. Final thoughts. From strategy to mastery. Frank closes the book with a reminder. The markets will always be uncertain, but your behavior doesn't have to be. Your plan won't eliminate losing trades, but it will eliminate emotional trading, and that's the real win. Suggestions to help you move forward. As you close this book and video, here are 5 powerful next steps. 1. Print your trading plan. Keep it visible while trading. 2. Focus on one setup. Build deep skill before diversifying. 3. Use a demo account first. Practice execution without risking capital. 4. Join a trading community. Share ideas. Stay accountable. 5. Track your growth. Celebrate progress, not perfection. Remember, trading is a journey, not a jackpot. Every win, every loss, every mistake is a lesson, shaping your edge. And that brings us to the end of Supply and Demand Trading by Frank Miller, a practical, no-nonsense guide that turns market chaos into structured opportunity. If you've made it this far, you're already ahead of most traders out there. Why? Because you now understand that consistent profits don't come from luck. They come from discipline, planning, and mastering your own psychology. This book isn't just about technical charts. It's about building the mindset and strategy of a professional. So whether you're just starting out or refining your edge, remember, your success won't come from predicting the market. It will come from preparing for it. If you found this summary helpful, imagine what applying even one strategy from this book could do in real-time trading. And if you're ready to keep growing with us, hit that subscribe button, give us a thumbs up, and turn on the notification bell so you never miss a powerful new book summary from Book Loom. Now it's your turn. Drop a comment below and tell us, which audiobook or trading book should we break down next? We're all ears, and your suggestion might be our next deep dive. Until then, stay sharp, stay focused, and as always, keep learning, keep winning.